U.S. stocks rose Friday following a 4-day losing streak. The market appeared to react favorably to better than expected retail sales data, and all three indices surged. The markets may also be reacting to the blowout second quarter results from Citi, perhaps hoping that banking industry peers will also post positive results in the coming week. However, JPMorgan boss Jamie Dimon cautioned that the risks to the U.S. economy appear nearer. He went on to explain that the never-before-seen quantitative tightening is expected to have negative consequences. Dimon further stated that there's a range of potential outcomes from a soft landing to a hard landing, all driven by how much interest rates go up, the effectiveness of quantitative tightening, and defective, volatile markets. And that's definitely what we have, defective, volatile markets. With the S&P 500 down about 21% year to date, the situation for stocks has been pretty grim. But according to legendary investor Jim Rogers, it's just the start. Rogers said that this has to be the worst bear market in my lifetime, which means it will go down a lot and it will last a long time. However, if you follow Jim Rogers, you'll know he said similar things 2 weeks ago, 2 months ago, 2 years ago, and even longer ago. So, take that with a pinch of salt. All right, back to the salt mines. Now we're looking at the 6-month daily chart on the volatility index, or the fear gauge, and as you can see, the symbol is $VIX using stockcharts.com. We've talked about this before. You can see here, looking at this bottom trend line, more or less moving on up. The top trend line is moving, say, horizontally. So the pattern is becoming tighter and tighter and tighter, and it's coiling. It's not quite ready yet, but when it does coil and get to that pinch point, this is either going to pop up or pop down. If it pops up, that's bad news for the market. So we're going to be watching this very closely. As I said before, this seems to be a base here under this 200 moving average. Then we have an interim base that's above the 200, and back here another base below that 200 moving average, then an interim move above. So I'm expecting this next move to come down below that 200 moving average and set another base, and that will perhaps be set for another move on up. For now, the market is going somewhat sideways to up, but we're going to look at that in a second. Now, down here, you see the MACD in the lower portion of the chart with the fast line moving down below zero, so it is weakening. And it has made an attempt that failed, so it's moving back down here, but it's going to gain some strength. I think once here in this chart, once we come under this moving average, down perhaps into the 22 range more or less, I'm going to be looking at that. It might even go down to the 20 level, but we're just going to have to wait and see. All right, let's go to our charts. And now we're looking at a 6-month daily chart on the spiders, the SPY, and the close on Friday was 385.13. So we've been looking at this downward channel. Let's put the lower trend line in like this, more or less, and the upper line moving through like that, more or less. Now, since mid-June, we have a new channel moving on up. There is the bottom trend line, and let's put that top trend line like that. So we're moving on up, but we have to wait and see if this is temporary or if it extends. Right now, this looks relatively weak. We're bumping up against that 20 EMA. We need to move it up to that 50 EMA and perhaps even higher to really change this overall downward trend. So let's take a look at the oscillators. Volume is not going to tell us too much. Here into the MAC, you can see that this level here is slightly lower than this level here. Now, this move at that point is slightly higher than where we are right now. Next week, this may continue up, but we need to watch because this is still relatively weak in comparison to the proportional move of this cycle there. So let's go back up and see in the chart itself, this is that upward move here, and definitely this move is not as strong as it was before on the way up. So is it going to make it up through these moving averages up to this trend line and break through? I'm not so sure. Next week may be decent depending upon the rest of the banking earnings. So let's move on down here. Histogram looks fine, but into the price rate of change, you can start to see the weakness beginning here. Similar to this move here, we had some choppy movements at this point. It came down, the fast line came down through the slow line, tried to make a move up, but then it broke down. Perhaps the same thing's going to happen here. We have a bit of a move here. We can continue on, but it just looks like this move here is weak and actually starting to roll over. So we'll have to wait and see next week. Moving down into the relative strength, you can see that that relative strength is not very strong, relatively weak in my opinion. Now into the stochastics, similar to the other oscillators, we have this fast line moving on down here, and it's moved underneath the slow line. So this move on up is relatively weak, and we're going to see if this gets reflected on back down. If it fails, it might continue on up, hopefully to that say overbought territory, but we have to watch that closely because these oscillators are indicating weakness. And the same thing here with the Williams. The Williams is heading on up. It probably will get into that overbought territory, but is that going to bring the other oscillators on up? We're just going to have to wait and see. Things right now just look a little too weak for my liking. Moving up here into the price chart, one last look, and you can see here a very weak move on up. So I'm still on the sidelines. And for today, that's ChewDog Charts. Thank you.